Whenever you tap your card to buy something or see your paycheck land in your account, have you ever stopped to wonder what's really going on behind the scenes? It's not just numbers flashing on a screen. It's actually a huge, incredible machine that keeps our entire economy running. Today, we're going to pull back the curtain and take a look at the gears of that machine: money, banks, and the hidden system that connects it all.
So, here's the plan. We're going to start with the big question. What even is money? Then, we'll get into what commercial banks do. And you're going to love this part, how they literally create money. After that, we'll see who's in charge, the central bank. And finally, how they try to control this whole massive system. Let's dive in.
All right, first things first. What is money? I mean, we use it every single day without a second thought. But the idea has evolved like crazy, from actual cattle to digital code. So what gives that piece of paper or that number on your screen any value at all? Let's find out.
Way back, before we had anything like wallets or apps, money was something that had its own real, tangible value. Take ancient India, for example. They used things like grains and cattle as currency. Think about it. You could eat the grain, you could use the cattle. Its value was obvious, which made it a pretty straightforward way to trade.
Yeah, but try fitting a cow in your pocket. Not exactly practical, right? So naturally, the system evolved. We got metallic coins. These punch-marked coins from about 2,500 years ago were a total game changer. They were portable, they were durable, and they were standardized. A huge leap forward.
And it didn't stop there. As empires got bigger and grander, so did their money. The gold coins from the Gupta Empire, for instance, were just stunning. They weren't just for buying stuff. They were a symbol, a statement of immense power, wealth, and incredible artistry.
And this tradition of using metal for money, well, it stuck around for a long time. It continued through different eras, like with rulers from the Tughlaq dynasty. For centuries, the basic idea was the same. Money was a physical thing that had real value in and of itself.
Okay, now, this is the part where the rule book gets thrown out the window. The cash and coins you have right now, they're not made of gold or silver. So why on earth do we accept them? Simple, because the government says they're worth something. Modern money's value doesn't come from the material it's printed on. It comes from our collective trust in the system that backs it. That is a massive, fundamental shift.
Okay, so money is now based on trust. But where does it all go? How does it move around? Well, that brings us to our next big player, the commercial banks. And let me tell you, they do a whole lot more than just keep your cash in a big safe vault.
You can think of commercial banks as the big matchmakers of the economy. At their heart, they're intermediaries. They take deposits from people like us, the savers, and then they provide loans to other people and businesses, the borrowers. This one simple function is what makes our economy go round, fueling everything from a new car purchase to a new factory.
So how do banks actually make their own money? Well, it's a surprisingly simple idea called the spread. They pay you a certain lower interest rate for keeping your savings with them. Then they turn around and charge someone who needs a loan a much higher interest rate. That difference, that gap in the middle, that's the spread. That's their profit. Simple, but incredibly effective.
Now, the money that we all keep in our regular checking or savings accounts, the stuff we can get to right away, that has a specific name. It's called a demand deposit. And the name says it all, right? You can withdraw that money on demand anytime you want. It's the most liquid, most accessible money you have.
The classic example of this in action, a check. It might seem a little old-fashioned now, but it's just a piece of paper. It's a physical instruction to your bank to take money out of your demand deposit and give it to someone else. It's proof of that on-demand promise, letting you make a payment without ever touching physical cash.
All right, get ready for this next part because it's where things get really interesting. We tend to think of banks as places that just store money, but that's not the whole story. The truth is, commercial banks actually create most of the money in our economy. It's like a financial ripple effect. Let's see how they do it. So this brings up a couple of really big questions, right? If the bank is lending out most of the money on deposit, how is it still safe? And, this is the big one, how in the world does that lending process actually create new money out of thin air? The answer is a system called fractional reserve banking.
This whole magic trick hinges on one simple rule. It's called the reserve ratio. This is the fraction or percentage of any deposit that a bank is legally required to keep in its vault as cash reserves. It can't touch it. But everything else, the bank is free to lend it out. And that right there is the starting gun for creating new money.
Let's walk through it.
Imagine the reserve ratio is set at 20%. You go and deposit 100 rupee in your bank. Okay, so the bank has to keep 20 rupees in reserve, but it can loan out the other 80. Now, here's the key. The person who borrows that 80 rupees, they're going to spend it, and it'll end up being deposited in another bank. That bank then keeps 20% of the 80 and lends out the rest, and the cycle just starts all over again.
So, after all those ripples of lending and redepositing, what's the end result? Get this. That one single initial deposit of 100 rupees has now supported a grand total of 500 rupees across the entire money supply. Wow, the bank didn't print a single new note. It just multiplied the money through lending. That is the money multiplier effect.
Okay, so if commercial banks have this incredible power to create money, you've got to be wondering, who's watching them? Who's in charge of this whole operation to make sure it doesn't get out of hand? Well, that is the job of the central bank, the ultimate guardian of the economy. The central bank, like the Reserve Bank of India, is the boss of all the other banks. It's got some huge responsibilities. It's the only institution allowed to issue physical currency. It acts as the government's personal banker, and most importantly for our story, it's the one that controls the entire money supply and that whole credit creation process we just looked at.
Now, the money the central bank creates is a special kind of money. It's called high-powered money. A good way to think about it is like this. It's the foundation of a building. It's the solid base of physical notes, coins, and bank reserves that commercial banks then use to build that entire skyscraper of credit on top of.
So this brings us to the final piece of this huge puzzle, controlling the money supply. Because if you want to steer something as powerful and complex as an entire economy, you first need a really good dashboard. You need to be able to measure what's going on.
And it turns out, money isn't just one single thing. Economists measure it in a few different ways. And it all comes down to one word: liquidity, which really just means how fast you can get your hands on it and spend it. M1, or narrow money, is the most liquid stuff. The cash in your wallet, the money in your current account. As you go down the list to M2, M3, and M4, you're just adding in money that's a little harder to access quickly, like savings in a post office or long-term bank deposits.
So all of this, how money's made, how it's measured, the interest rates, it all leads us to one last really critical question to think about. What happens when the rate of inflation is actually higher than the interest rate your bank gives you on your savings? This is called a negative real interest rate, and it means the money that's just sitting in your bank account is actually losing its buying power day by day. So, how does that change the way we think about saving or spending and the value of money itself? It's a powerful thought that connects everything we've talked about today.